Do you want to grow your money without losing sleep? The truth is, you don't have to risk it all to build wealth. Too many people chase high-risk investments, hoping for massive returns, but it's possible to grow your wealth without the stress. In this video, I'm going to share 8 smart ways you can grow your money while keeping risk low. So if you want to invest wisely and sleep better at night, stick around. 1. High-yield savings accounts, HYSA. Let's start with one of the simplest and safest options, high-yield savings accounts, HYSA. This is one of the easiest wins out there. While your regular savings account might offer next to nothing, a high-yield savings account gives you FDIC protection while earning you 4% to 5% APY, or even more, depending on where you go. This makes it perfect for an emergency fund or short-term goals. The best part? Your money stays liquid, and you can open one of these accounts in minutes. However, keep in mind that these accounts won't always beat inflation over the long term, and their returns are subject to changes in the Federal Reserve's rates. But for peace of mind and liquidity, it's a great option. 2. Certificates of deposit, CDs. Next, let's talk about certificates of deposit, CDs. These are fixed-rate, FDIC-insured accounts where you lock in your money for a set term, typically 6 to 12 months. Rates are higher than standard savings accounts, sometimes reaching 4% or even higher. While your money is locked away, you get a predictable return, which can be a great option if you don't need immediate access to your funds. Just be aware, if you withdraw early, you'll incur a penalty. CDs are a stable, low-risk option for investors who know they won't need to touch their money for some time. 3. U.S. Treasury bonds. Another solid low-risk choice is U.S. Treasury bonds. These are backed by the U.S. government, which makes them one of the safest bets in the investment world. Treasury bills, T-bills, are short-term, offering solid interest rates around 4% to 5%, while longer-term T-bonds offer similar returns with a bit more stability. T-bonds can be a fantastic choice for those looking for predictable, steady returns. The risk here is minimal, as you're lending money to the U.S. government, which is considered the safest borrower on the planet. There's a lot of comfort knowing that your investment is virtually guaranteed by the government. T-bonds are also perfect for investors with long-term goals, as they offer steady growth over extended periods. While they may not provide the same level of excitement as high-risk stocks, they do provide peace of mind. T-bills and T-bonds also offer tax advantages in some cases, particularly at the state and local levels. While the returns may be lower than other options, their low risk makes them an excellent choice for conservative investors or those saving for retirement. 4. I-bonds, inflation bonds. I-bonds, or inflation bonds, are another great low-risk option. These bonds are designed to protect against inflation since their interest rate adjusts every 6 months based on inflation. This makes them a wonderful hedge against rising prices. With I-bonds, you can invest up to $10,000 per person per year, and they come with tax advantages as well. But they require you to hold them for at least a year before cashing out, so they work best for long-term goals. Their ability to adjust with inflation makes them an attractive investment when prices are rising. Unlike regular bonds, which can lose value in inflationary periods, I-bonds ensure your returns keep pace with inflation. The best part is that the interest you earn on I-bonds is exempt from state and local taxes, though you'll still have to pay federal taxes. If inflation rises unexpectedly, I-bonds can help preserve the purchasing power of your investments. For those who want a low-risk investment that can still protect their wealth from inflation, I-bonds are an excellent option. They're easy to purchase and require no ongoing maintenance. Plus, they can be a great addition to a diversified portfolio, providing a stable return with inflation protection. 5. Money market accounts, MMAs. Money market accounts, MMAs, are similar to high-yield savings accounts, but offer a little more flexibility and can sometimes give higher returns, ranging from 3% to 4.5%. MMAs are perfect for short-term needs or as a parking place for your emergency fund. They are also FDIC insured, offering peace of mind. The downside is that they may not always offer the best returns compared to other low-risk options, but they are a solid choice for liquidity and low risk. These accounts typically provide easy access to your money with checks or debit card access, which is a nice feature if you need to access funds quickly. MMAs also tend to offer better interest rates than a regular savings account, but the trade-off is that they require a higher minimum balance. They can be an excellent place to park your cash if you need it to remain liquid while still earning some interest. Like savings accounts, money market accounts are a safe and reliable way to grow your money over time with minimal effort. While the interest rates may fluctuate with market changes, the low risk makes them an attractive option for anyone looking for a secure investment. 6. Gold and silver investments. Let's not forget about gold and silver. While precious metals don't produce income like stocks or bonds, they serve as an excellent hedge against inflation and market volatility. When other investments are down, gold and silver tend to hold their value or even increase. You can buy them in physical form, coins or bars, or through ETFs like GLD and SLV. Having a small allocation in precious metals, around 5% to 10% of your portfolio, can help protect you from inflation and currency risks. Precious metals can be a great way to add a layer of security to your investment portfolio, especially in uncertain economic times. Historically, gold and silver have performed well during market downturns, making them a valuable store of wealth when other assets are losing value. Unlike stocks or bonds, they don't depend on performance of the economy, which makes them an attractive option when diversification is needed. Gold and silver also offer privacy and a tangible form of investment that isn't tied to the digital world. While they don't generate income, they can still play a critical role in long-term wealth preservation. 7. Broad-based ETFs and index funds. Broad-based ETFs and index funds are another great option. These are low-cost, diversified investments that track entire sectors of the market or even the entire stock market. Funds like VTI or SCHD offer exposure to hundreds or even thousands of stocks in a single investment, making them less risky than individual stocks. They have historically delivered annual returns of 7% to 10% over time, making them a safe bet for long-term growth. With their built-in diversification, broad-based ETFs and index funds are perfect for investors who want exposure to the stock market without the need to pick individual stocks. These funds are low cost, and they allow you to invest in a wide range of companies across various sectors. The more diverse your portfolio, the less risky it becomes. And these funds help minimize that risk by automatically diversifying across industries and market segments. Over the long term, these funds have consistently performed well, providing steady growth with lower volatility. By investing in these funds, you're letting the market do the work for you without having to worry about picking the right stocks. 8. Real estate investment trusts, REITs. Finally, let's talk about real estate investment trusts, REITs. These are a way to invest in real estate without becoming a landlord. REITs pay dividends and allow you to profit from real estate appreciation without the headaches of property management. While they can dip when interest rates rise, they provide steady dividends and potential long-term growth. REITs like VNQ or Public Storage, PSA, are great options to get into real estate without the hassle. They offer the chance to invest in a wide range of commercial real estate, like shopping centers, office buildings, or apartment complexes, without the upfront costs of buying property. Plus, they provide regular dividend payouts, making them a good source of passive income. REITs are perfect for those who want exposure to real estate without the responsibilities of owning and managing properties. They're relatively low risk compared to owning individual rental properties, and they can offer competitive returns, especially when held for the long term. There you have it, 8 low-risk investments that can help you grow your money steadily and securely. Whether you're looking for a safe place to park short-term funds or planning for long-term wealth, these options allow you to build your wealth without the anxiety of high-risk ventures. Remember, wealth building isn't about chasing quick wins or trying to time the market. It's about consistently making smart investment choices that protect your capital and allow it to grow over time. By diversifying into these low-risk investments, you're positioning yourself for financial success while minimizing the risk of significant losses. If you found this video helpful, don't forget to hit that like button, share it with anyone who needs a safer way to invest, and subscribe for more financial tips that'll help you grow your money smartly and securely. Thanks for watching. I'll see you in the next video.